Everyone, and welcome to today's webinar. We're just going to kick off just now. Just get our guys to start the recording so we can send this out after we've completed it today. Okay, so everyone, if you have any questions, you can submit these questions during the webinar using the box that's on the dashboard for the Log Me In webinar. So please use that throughout the webinar. We'd be grateful for your questions. We're looking forward to them, and we hopefully have provided some time to just go ahead and get into it. So today's topic, the SFC's Fund Manager Code of Conduct and what you need to know. Your host today will be Michael Langton and my good self, Derek McGivney. I'll let Michael introduce himself.
Hello, everybody. I just want to say a quick thank you to Derek and the Cordium team for inviting me to participate in this webinar. We obviously hope everybody gets, get some value from this. And just a little bit about me and myself. I've been with Line Data QRMO since the inception in 2006. Prior to that, I was deputy head of Treasury Risk Management for Fubon Bank, based here in Hong Kong. And before that, I had some stints with Investcorp and Bahrain Middle East Bank, performing private equity due diligence.
Thank you very much, Mike. Just a little bit about myself. I've been a senior consultant with Cordium since 2005, working with some of the most well-known private fund management over the years since then. Cordium is a leading provider of governance, risk, and compliance services. Prior to that, I worked in a risk, compliance, and audit roles at large retail asset managers that had significant alternatives operations. And Cordium has been working with asset managers and brokers in Hong Kong since 2014. Prior to the arrival here, I was responsible for running our AIFM team in the UK. During the busy period, I assisted about more than 100 managers do applications for AFMD as we helped develop and implement asset management risk standards for hedge funds, private equity, and various investment trust companies. The path ahead feels well trodden, but not as tangled as it was back then. So, moving on to our agenda. We are focusing on risk management and the key issues with the FMCC. We will hone in on key aspects of the changes to the Code of Conduct from a risk perspective. Mike will be summarizing what you should be looking at from an investment risk point of view, and I will highlight some governance and operational options that you might consider making. And then we'll hopefully get stuck into question and answers and hopefully come to a conclusion on what you need to do now and how you can prepare for a later time. We have a great audience here, so happy to field any questions. We won't be naming individuals unless you have an urge to be noted. So please feel free to raise any questions, concerns, or challenges which we can address. If we can't get to your questions, we'll try and contact you separately. We're going to try and leave as much time for questions. So without further ado, we'll jump into the meat of the seminar or webinar today. So what are we talking about today? Well, we're talking about the update to the Fund Manager Code of Conduct, just to remind everyone. When is it due? Well, it's due to be implemented by November 2008. So we've got 8 months to go. We are focusing in on private fund managers, which we expect will be affected most. We have to remember that the SFC, through this iteration, is making it clear that risk management is something that it expects all managers to have in place. Retail managers and managers of public funds should already be subject to a lot of these points and have structure in place to deal with them, we hope. So why has this come about? Well, this is essentially Hong Kong's catch-up to the international standards. Since the global financial crisis, since the requirements of implementation by the Financial Standards Board, in alignment with Dodd-Frank, the IOSCO requirements, it's essentially Hong Kong's interpretation of what fund managers are supposed to do from an investment and operational risk point of view. We also highlight that there's a couple of other cleanup issues from legacy issues to clarify how the SFC deals with specific items, such as, a change to the allocation wording, a change to wording on conflicts, some updates in relation to execution. The objective of today is to make it clear that essentially the task ahead is not as simple as you may have first thought. It's probably going to be more than a simple gap analysis and procedure update. The key is to ensure that the changes that you're intending to make can be shown to be effective. However, at the same time, it's actually not as complicated as you may have thought. It could be merely a codification of what you already do and a rearrangement of your governance processes to make sure you can achieve that efficiently. And a lot of these points are not new requirements, but I believe to be a clarification of what is expected of firms. We've already seen how the SFC is probing on how managers address liquidity risk. And following November, and perhaps even earlier, the audit teams will be armed with a much more detailed screening tool to look at what you're doing. Therefore, the function today is highlight what this update means and consider what firms can do to assess it. We tried to include everything for everyone in today's webinar, but we had to do a lot of pruning to keep us within the time frame. As such, we'll be putting on further webinars on specific topics as we run down towards the implementation date. So let's get into the key requirements. The first thing to say, and the first point that really comes up, is the code requires you to establish a designated risk function. It's hard to argue proportionality can be applied in that case. It does say, however, establish and maintain effective policies and procedures. And this is where we can lay our proportionality hat. The challenge is there is no clear measurable way to confirm effectiveness absent an actual crisis. Therefore, it may be difficult to argue where you've not followed the SFC direction to the letter. However, following the code to the letter will not guarantee effectiveness either. As witnessed during the global financial crisis, when the tide goes out, it will become abundantly clear which programs have been effective. And now, due to the MIC, who will be responsible? Proportionality is key to determine what is necessary to achieve your objectives, which is to manage the risks that apply to you. Detailed infrastructure is going to be unavoidable for large managers and anyone with retail funds, and they should have people and processes in place. However, the retail managers are going to need to take care, because trying to extend a retail platform in a private fund with more complicated assets will have its own challenges. Growing and emerging managers will be challenged with the segregation of duties given the different responsibilities they will have. This issue was already raised during the conversation around manager in charge. This will be a key challenge in trying to assign the responsibilities appropriately so that you maintain that segregation of duties. However, what the code does not say, or it doesn't prevent you from essentially using existing resources to perform the functions. To me, it's clear that as long as you can demonstrate effective policies and procedures are in place and ensure that the function is performed effectively, you will be able to get through without too much investment in resources. The updated code highlights areas of specific concern throughout the changes it has made and points to some guidelines which the regulator expects to see. To me, this is slightly strange, as it requires a risk management assessment to take place, but also identifies the outcome of your risk assessment and what controls it will be looking for. To summarize these outcomes more clearly, I turn to Appendix 2 first, which lays out the summary of the expectations. Appendix 2 is a good, clear indication of what the SFC will expect to see once the implementation has been completed. So there's nothing necessary on the left-hand side there. There's nothing necessarily too surprising and nothing that we have not seen before. Establish an effective policy and take into account, where applicable, all the suggested risk management controls laid out. IESCO has turned its focus primarily to liquidity and the management of liquidity. This should be the concern shared by regulators, investors, and employees of all firms, and actually makes the management of risk more relevant. We would also refer you to the paper issued recently by IESCO on a lot of these matters. Mike will discuss them later. Once you have identified the gaps in what you're doing, then you will need to ground the new requirements into effective feedback loop to continually assess and reassess effectiveness. I could never get the value of idea of Kaizen, continuous improvement by increment, out of my head. It does not necessarily need to be perfect the first time, but if you employ an effective feedback loop, it becomes difficult not to ensure that these issues are being actioned. We'll come back to these in a second. So in addition to the appendix, There is also specific areas within the Fund Management Code of Conduct that the SFC refers you to. So in addition to the general risk requirements, you've got effective policies and procedures, requirements to identify and assess, quantify risk, put appropriate governance in place, monitor, manage, and mitigate those risks. The SFC has specifically pulled out particular areas. So disclosure of expected maximum leverage is a requirement, and also to disclose how you have calculated. This is a bit of a Goldilocks question. You don't want to disclose such a large amount of leverage that it would seem ridiculous for anyone to invest in you because you're taking so much risk, or so small that it will be easy to breach. This is something that people obviously are going to need to take care of because the definitions are going to be quite important. But again, there is a lot of precedent in other jurisdictions in this regard, and firms will have the flexibility to apply as they need. Liquidity, now that's going to be a key focus. We would recommend that all firms do a liquidity profile assessment of their current portfolios as a start. Mike will talk about this in detail. But what I like to say is the code goes on to specifically highlight requirements to integrate liquidity management into investment decisions. I really, really like that because it really highlights the fact that they're not looking for you to have some sort of argument between risk managers and investment managers. It's all part of the same thing. Makes this a little bit more easy to implement than some of the previous iterations in other jurisdictions. It requires you to regularly assess the liquidity of the fund, regularly assess the liquidity of the fund's liabilities. Again, no major, new things there. But I think it's more of being able to demonstrate that you're doing it on a regular basis. Regularly conduct assessment of liquidity in different scenarios and stress situations. So again, something that we have a lot of experience with, but something that potentially you may not have the records in place. Disclose the liquidity risk tools or exceptional measures that affect the redemption rights. So I think a big thing here is, if you've not already done so, you need to stress your portfolio. It's a bit like getting a body check. You might put it off, but it's important that it gets done. And also, check if you'll need to change your fund terms. If you do need to change your fund terms, it's probably a good idea to book early with your lawyer to have a look at what you'll need to do. There are also some additional interesting points that are raised by IOSCO's recent report on this particular issue around the whole concept of why firms, for example, didn't necessarily use their redemption gates at the time of the crisis, and whether they were appropriate for the types of funds that were being run. Sorry, just some water. So, custody. Now, this is an interesting one. If you don't appoint your custodians, you will still be responsible for overseeing what they are doing on a day-to-day basis. And yes, if you are using client assets or taking risks with them, you must be able to account for this risk. However, there's a potential snag here in looking at the relationship between the fund, the prime broker, and where the assets are actually held and in what form. That will be key. And as we know, this is something that the SFC has been specifically looking at. I wonder whether the IOSCO direction was an impetus for the PB review by the SFC. Anyway, I'm sure there will be more to be discussed here over the coming months. Securities lending also relevant to custody. Who is getting the benefit and who is taking the risk? How is the manager overseeing this and accounting to clients? Valuations need to be done properly by people who are qualified to do them. Again, it's all pretty sensible. Subjected to independent checks, and the firm is expected to have appropriate policies and procedures. Having considered all these changes, questions naturally arise about how you can do this with the resources that you currently have. Before we get on to those solutions, I'll bring you on to the challenges, and Mike is going to take us through some of the key points on investment risks. Over to you, Mike.
Great. Thank you, Derek, and hello, everybody. As Derek had mentioned, I'm going to be focusing on investment risk techniques. So without further ado, if we could just go to the next slide, that would be great. Hi, Derek, are you able to go to the next slide?
Yeah, Mike, I think there's a little bit of delay. It should come through now.
Oh, okay. No problem whatsoever. Okay, so getting back to the task at hand, Before I dive into the details here, as you can see on the page, I just want to highlight some key points within the FMCC. Particularly, there is a section called 3.11, and it mentions that we should identify, measure, monitor, and manage our risks. And I think that's a good framework. It's a good risk management process. It's one that I've used over my career, and it's one that I believe the SFC is taking from other jurisdictions and from other best practice publications. And that's going to be the framework for which I continue through this webinar. And the other point that I'd like to make is that Derek had mentioned Appendix 2. This is where I get a lot of my ideas for presenting the specifics with respect to investment techniques. So if you haven't read it yet, I highly recommend that you do. Now, the important thing is with regarding Appendix 2 is that they're only suggestions. So it's not a black and white paper telling you that this is exactly what you need to do. Again, it goes back to proportionality, as Derek was mentioning earlier. So if you're a smaller emerging manager, there may be some things that you don't have to do, but it does not absolve you from having to do certain risk management techniques and processes. Of course, if you're a much larger, complex manager, then the requirements are probably going to be a bit more burdensome. But it could be the fact that, as Derek had said, you already have many of these processes in place, and what the FMCC, current requirements are just a codification of what you're already currently doing. Okay, so I just wanted to preface that first. So let's move forward. So going with what the FMCC is asking us to do, we're going to start with identifying and measuring market risks at the security level. So now we have about 6 risks here. We have equity, interest, volatility, FX credit, liquidity risk at the asset level, and liquidity risk at the investor level. And again, if you're a multi-strategy, then it's very likely that all of these risks are going to apply to you. But if you're a long-short equity or a long-only fund, it's probably equity risk and only FX risk that is, going to apply to you. And you don't have to expand too much in your policies and procedures on things like credit risk or volatility risk for that matter. But regardless of whatever strategy, let's just go through each one of these very quickly. So what do we mean by equity risk? This is probably the simplest one. This just means, your portfolio has a direct exposure to stocks and other Delta One related instruments like futures and equity swaps. And the way that we measure this particular market risk is quite simple. We can go directly to the exchange and get the last quote, and then calculate the difference between one day to the next. And it also gives us a way to calculate our direct exposure. Regarding interest rate risk, this is more for fixed income and rate, global macro type strategies. And here, in terms of how we're measuring the risk, we're looking at our exposure to changes in yield curve movements. And the specific techniques that risk managers such as myself have been using, over the last couple of decades, and I'm sure a lot of you are familiar with, some of these. Some of these techniques include, which I've mentioned here, DV01, which is effectively a one basis point shift, parallel yield curve shift in the representative yield curve. Modified duration. I have not put down here 10-year equivalents, but we can also use those as well. And then, of course, we need to be able, according to the FMCC, stress test yield curves by doing processes such as parallel and non-parallel yield curve shocks. I'm not going to go into too much detail as to how to do these or define, any more about what these specific techniques entail. But if you would like to reach out to me after the webinar, I'd be more than happy to schedule a meeting with you, and we can discuss these further. So let's move on from interest rate risk and talk a little bit about volatility risk. This is just this assumes that you have an options book, and it's just measuring your risk sensitivities with respect to the option book. And typically what we do here, risk managers will look at the Greeks, which I'm sure a lot of you are familiar with. So delta, gamma, vega, theta, and rho. And the calculations for these, depending on the security complexity, can get very, very complex, or they can be very, very simple. Moving on from volatility risk, another market investment risk that we're going to be looking at, that the FMCC suggests that we look at very closely, is FX risk. And that has to do with exposure to unhedged currency risk. So, you know, if you're making any direct bets and you haven't hedged them, you're going to have to be able to understand what your FX exposure is and be able to calculate it accordingly. Let's move on to credit risk. So this is looking at your exposure to the credit quality of the security, and typical techniques involve looking directly at 5-year or 10-year CDS spreads, credit ratings from the likes of Moody's and S&P, some more sophisticated calculations like jump to default or jump to zero, and of course CSO1, which is akin to DVO1 in interest rate risk, which is the 1 basis point sensitivity analysis. Now, last but not least, we're going to talk a little bit about liquidity risk at the asset level and investment level. Now, I don't want to give you the impression that because I put this last that it's not the most, it's the least important. In case it's probably the opposite. Liquidity risk has its own section in the FMCC. So the SFC is going to be looking at this very, very closely, particularly when they do an audit or they come in and visit you. I think that they're going to be very, very heavily focused on liquidity risk at both the asset and investor level. So at the asset level, what do I mean? Simply, this is just the ability to sell an asset in a timely and cost-efficient manner. And there's a few ways that risk managers measure this. The most I think widely used technique is what we call days to liquidate. So you know, can I liquidate 95% of my portfolio in under a day, or will it take me 2 days, 3 days, 5 days? And the way that we figure that out is based on average trading volumes. And I'm not going to go into too much detail, but when we look at average trading volumes, risk managers also apply a conservative haircut to that figure as well, you know, just to make it, essentially more conservative as opposed to just looking at average trading volumes themselves. Now, I'm going to talk a little bit about bid-ask spreads and the number of market dealers that are available. And this is really more for the fixed income products. Measuring liquidity for fixed income products such as bonds is far more difficult than it is for equities. And that's just by virtue of the market observables being more challenging to acquire than those for equity-related products. Nonetheless, the FMCC within Appendix 2 suggests that we look at bid-ask spreads, and intuitively, we know that if the bid-ask spread is tighter, then the bond is most likely to be liquid compared to a bond where the bid-ask spread is wider. And they are actually suggesting a bit more complicated calculation around bid-ask spreads. In fact, from looking at the Appendix 2, there's some suggestions that they want a VAR-like bid-ask spread calculation. Again, I'm not going to go into too much detail as to what that entails, but yeah, beyond just looking at bid-ask spreads, it could be a little bit more complicated than that. Finally, number of market dealers available to quote a price. And intuitively, if you have more dealers looking to quote a price, then we can assume that the bond is liquid or more liquid than you know, a bond where there's only one person quoting quoting a price. So yeah, pretty straightforward on that interpretation. Now I'm going to just talk about investor level very, very briefly. And in fact, Derek has already mentioned about it on a previous slide. So liquidity risk at the investor level, this just simply means to me having enough cash on hand to meet sudden investor redemption requests. And in Appendix 2, there are a couple of suggested ways of measuring this. And one of them has to do with stress testing or a historical stress test. To me, the suggested example within Appendix 2 is not very clear. And if you're an emerging manager, you don't really have any historical background to be able to assess you know, what your redemption cycle looks like. So I think there's going to be a bit of leeway here from the SFC when they interpret you know, how you're applying the stress test with respect to liquidity risk at the investor level. Okay, great. Next slide, please. All right, so now before we talked about um, identifying and measuring risk at the security level, I'm just going to briefly talk about at the overall portfolio level. Why am I doing this? Well, the FMCC specifically asked that we need to do not just security level, but we need to look at risk at the overall portfolio level. And I think the three best techniques that allow us to do this are value at risk, or VAR. And VAR comes in primarily three main flavors or methodologies: parametric, historical, and Monte Carlo. Now, why is this an overall portfolio risk measurement? Well, VAR, as many of you probably know, considers the correlations of your securities within your portfolio. Now, historical stress tests, we can get a good idea of how the overall potential P&L would move under a historical simulation, such as the 9/11 incident, the Lehman crisis, the 1997 Asian financial crisis, and we can go through a significant amount of simulations. The Appendix 2 does not say that we need to do any specific historical simulation. Obviously, you should pick the one that is most suitable to your strategy. And what we're doing here with the historical stress test is that we will take your current portfolio and simulate it over, let's say, what happened during Lehman's bankruptcy, and then we would see the resultant P&L impact and how your portfolio would have performed if the Lehman crisis was to happen again. Now, we all know that history does not repeat itself exactly, but it does rhyme. So that's why these historical stress tests are very important, to risk managers, and now it seems to the regulators as well. Last but not least, we have sensitivity analysis. This is different from stress tests because here now these are more forward-looking in that we are shocking certain risk factors such as equity price movements. We're looking at things like credit spreads or volatility. For example, we can say, what would happen if credit spreads widen 100, 200, 300, 500 basis points, or if they tighten in the other direction? Or what would happen if interest rates, parallel or non-parallel yield curve shift, widen or tighten or flatten or steepen, et cetera, et cetera? What would be the resultant P&L impact on my portfolio? So yeah, I think these three, if you're performing these already, great. If you're not, you may want to look at implementing these in order to comply with what the FMCC is asking regarding investment risk at the overall portfolio level. Can we move to the next slide, please? Great. So continuing with the theme of identifying, measuring, the next step we need to do according to the FMCC is to monitor and to manage the risk. So once we've identified and measure, what's the next step? So the next step is to monitor investment risks. And as a risk manager, to me, this means that we need to know what our hard limits are and what our soft limits are. Now, hard limits are typically per your constitutional documents, like your PPM or within your pitch book. And these are investment restrictions. And to give you an example of what could be an investment restriction, it could be sector concentration risks. For example, not more than 15% of your portfolio can be in any one sector, like automobiles or telecommunications. Leverage, which has its own section in the FMCC. I can't lever the portfolio more than 2 times or 3 times. If that's a hard restriction, it needs special attention. Then we have soft limits, which are still important, but they're typically not within constitutional documents. They just serve as a form of internal guideline. And in my experience, here are some examples that I've seen as internal guidelines. Days to liquidate, which we talked about before. Stop loss, which I'm sure everybody's familiar with. And I'm also starting to see as a soft limit VAR as a percentage of NAV. Now, before I talk about managing investment risks, one more thing about monitoring investment risks. When you set up these limit structures or these limit frameworks, there's usually an embedded alert system. For example, let's go with sector concentration. Maybe if 50% of the limit level is utilized, that's warning number 1. If 75% of that limit level is utilized, that's alert level 2 or warning number 2. If you breach 100% of the utilization level, that's a breach. And if it's a hard limit, that needs to be effectively communicated throughout the organization. So I think that's a good segue into managing investment risks. So when there is a breach, we need to be able to manage that. And what I think that the FMCC is talking about with respect to managing is that there is a clear, transparent, and identifiable way of escalating risk management issues throughout the organization, particularly the C-suite and the board of directors. Now, the board of directors, they only have to get involved if there's a hard limit breach. They don't need to get involved if there's a soft limit breach. But nonetheless, I think on a quarterly basis, it's still helpful to keep them informed of soft limit breaches as well. So moving forward on managing investment risks, this typically involves the establishment of what I call the RMC, or the Risk Management Committee. Now, if you're a startup, the Risk Management Committee is most likely going to be just the 2 ROs, as opposed to if you're an established fund manager that's been in existence for over 5 years, you probably already have a CEO, a CIO, a risk manager, legal. So all of those are likely candidates to be within the Risk Management Committee. But again, it does depend on your size, and proportionality is going to be a major factor in determining what constitutes the RMC. The last point, well, I guess I've already talked about it, the escalation of limit breaches. But the one important thing here is you're not just showing the SFC that you have this policies and procedures books that looks nice and shiny when they walk into your office. No, it's got to be more than that. You got to be living this policies and procedures. But how do you demonstrate to the SFC that you're actually doing what you're purporting within your documents? Well, the way that you do that is that you keep very detailed records of any breaches that may occur, and you keep very, very detailed records of the processes involved in calculating and measuring these risks, and why you've identified certain particular risks. And then you keep minutes as to, if there are any changes that occur throughout the risk management process. So it's got to be a living, breathing document, and there's got to be a historical audit trail that you can provide to the SFC when they come in to do an audit on you. Great. I think that that's all I got on this slide. If we can move forward. Okay, so this is the last slide from me. Just a couple of quick considerations. As you're listening to me, you're probably thinking, well, do I need a full-time risk manager? Again, this relates to proportionality. If you're an emerging manager, there are ways that you may be able to not need to hire a full-time risk manager. And again, this relates to the MIC, as Derek had mentioned earlier on. I'm not going to talk too much about the MIC, but yeah, to answer this question, it really depends on the size and complexity, and what current stage of evolution are you at, with respect to your fund. So what types of risk systems, number 2, what types of risk systems will be needed to identify, measure, monitor, and manage these risks? Again, it's proportionality, and it's going to have to do with the complexity of your strategy. So if you're a long-only, long-short equity fund, you probably don't need as sophisticated of a risk system if you're a multi-strat or global macro fund that's trading listed OTC, every product under the sun across global markets. So you really got to figure out what's appropriate for you. And perhaps maybe have some questions later on that we can answer towards the end. And with that, I'm going to pass back to Derek.
Thank you very much, Mike. That was very informative, very useful stuff, and good reminders on what is necessary to be done. And also a good sort of segue into, with regards to the Fund Manager Code of Conduct, what you're required to do, and, what you do from an overall governance perspective, what you need to do from a non-investment risk perspective, and what you need to do from an investment risk perspective, are being laid out quite clearly in the documentation, and firms have to work out how they're going to essentially address these concerns. Just a reminder, we've also been receiving a number of questions. We will summarize the questions that have come through, and we'll go through them at the question section. But please do remember to submit any questions you may have, because it will provide for informed debate when we get to that part. So essentially, we're going to talk about key points on operational risk requirements and how firms essentially manage all of these new things that are going to come up. And I'm going to go back to my feedback loop that I talked about earlier, because I think this is key in regards to how we deal with any of the new regulatory requirements that are coming in. Because, you know, the change of regulation is essentially the norm now. Every year there are new regulations that people have to deal with, not just from the SFC, but from other parts of the world. So in order to maintain a continuous, you know, process to ensure that you're staying up to date, you're staying ahead of the group, that you're, you know, staying on top of the continual changes that are being introduced by external factors, regulatory change, market change, internal change, essentially. There is a few ways which we have witnessed that firms do very, very well when it comes to managing that kind of change. And essentially, it's about taking all those requirements, recognizing the change is occurring on a regular basis, and introducing a regular review process. This is a fairly straightforward kind of process that anyone can implement, and I think this is key to stand behind your governance, your risk, and your processes. So I'm just going to quickly go through some of those techniques. Obviously, identify and assess the risks that you may be subject to. So we've talked about some of the initial risks from an investment perspective. We've talked about some of the operational risks that might come up. You can use whatever framework you have available, preferably one the regulator has provided, or one that your due diligence investors might be looking at. We've developed a framework from a banking model and adapted it over many, many years to create a simplified version for asset managers. The SFC has published a document in 2015 called Asset Management Looking Forward, and actually that's a great resource in terms of looking at what you would be expected to be looking at, and obviously the new Fund Manager Code of Conduct is going to contain some of that information. We also have sources from the Financial Stability Board, IOSCO, the other regulators, and even the World Economic Forum obviously is reminding us of what our specific risks need to be. So once you've identified those risks and you've assessed their impact or probability on your business, firms will need to agree and adopt controls to manage those risks. The ones suggested by the SFC, or better ones if you come across them. It's important that you discuss the risks with your senior management, obtain consensus, and get people on the same page. Assign responsibility for those risks, and assign responsibility for monitoring those risks. Formally adopt controls to manage, monitor, and mitigate. I think this was evident in Mike's presentation in regards to the investment risks, but it also relevant in relation to operational risks. Meet your senior team to discuss the emerging risks on a regular basis. Discuss the effectiveness of how your controls are satisfying your need to be effective in this regard, so you can demonstrate that your effective process is sufficient to cover the risks that you're taking. Monitor the high impact or high probability issues and deprioritize those that are irrelevant. Manage your provider's risk management profile. Disclose what you cannot mitigate so that your investors are aware of how you're managing and what you're not managing. And then on a regular basis, review what's left over, the residual risk after you've put your controls in place. Reassess those risks on a regular basis and continually repeat this. It's really treating your business as if you are an investor in it, which of course you are, and your employers are also. I mean, your employees are also investors in that way. And by the way, if this takes more than 4 or 5 meetings every year, you're probably spending more time than you necessarily need to. Once you start thinking with this sort of process in mind, there are other things that the SFC refers to from time to time that will be something that you will naturally do. We, for example, suggest that firms undertake the following on at least an annual basis. Well, the reason we say on an annual basis is because circumstances change, and it's always good to reassess your controls against the environment to ensure that what you're doing is up to speed. So ones I'll pick out there, recently the SFC has highlighted its issues with regards to execution, and that it's analyzing how execution is undertaken. I suppose as a result, not of what the regulators have been saying on best execution over the last year, we've already adopted a process that we believe is best practice in regards to ensuring that no matter what type of investments you're investing in, that you have a standardized process for assessing the services that you're being provided by your brokers and looking at the prices that you're spending on behalf of your firms. So at least have a record of reviewing that on a regular basis. We have been discussing internally how potentially a MIC assessment or annual review might be appropriate. That really sort of, it speaks out to me that essentially this process has been gone through, but it shouldn't be something that's thrown away into the cupboards and not looked at again. I think it's well worth individuals sitting down and looking at what they're responsible for so that nothing sneaks into the gaps between the crevices of responsibilities. It's the same ideas throughout. Identify, assess, agree, adopt, manage, mitigate, disclose, reassess. And this doesn't have to happen all at the same time. You can schedule this out across the year. For some of the firms that we've started working with, we were surprised that, for example, they may not have a formalized meeting on the basis that these are the issues that are being discussed on a regular basis between the senior management team. But I think it's all basic stuff. The requirements here is you need a policy and you need to demonstrate that it's effective. It needs to be reviewed for effectiveness. Does it cover everything that the regulator would expect? Have you checked what the latest regulatory expectations would be? What your investors would care about? Is it effective? Does your senior management team believe it's effective? Does your senior management team believe that there's an appropriate resources provided in relation to the risks? And have you formally adopted any of these processes and procedures? One key thing to remember that if it hasn't been documented, certainly from a regulatory perspective, it essentially does not exist. So going back to the point of when the tide goes out or a crisis occurs and everything isn't working effectively, if you don't have the documentation to demonstrate this is taking place, you're potentially in a difficult position in regards to demonstrating that you had effective policies and procedures to manage those risks. So I'll just have a look through some of the questions that have come through, and I'll ask Mike to sort of chime in on the operational side of things and if he has any views from his experience.
Sure. So are you asking me now, Derek, on the operational side of things?
Yeah, just, I thought it'd be useful because, I've come from it from more of an operational focus, but, we work with a lot of clients in relation to looking at how they embed their risk management into the governance.
I know, absolutely. I mean, as you know, our firm, not only do we do risk management, but we also do middle office outsourcing. And, I guess just to, distill what I believe the FMCC is trying to convey into a simple message, really what it comes down to being able to segregate duties between the front, middle, and back office. And it's also about trying to automate in an STP, or what I call a straight through processing fashion, as much as possible so as to mitigate operational risks with respect to the front, middle, and back office processes. And a lot of the managers, or a lot of you that are on this call right now, you're probably already getting a lot of these questions from investors when they do due diligence on you. And you already have a framework to answer those questions. Maybe it's an AIMA DDQ, your internal policies and procedures documentation, your BCP, disaster recovery. I'm sure you have swaths of documentation to show to these investors when they come visit you before they put money into your fund. Well, I'm certain that a lot of that will be okay for the FMCC and for the purposes or for the requirements of the SFC when they come in and visit you. But I don't want you to think that it's something that you shouldn't review, or take too lightly. There may be certain areas that you have gaps that are not meeting what the FMCC is requesting of you. So it is definitely worth taking a look at what you have so far, what you've written down, what you're currently practicing on a day-to-day basis, and then looking at not only what you've given to investors, but what is it that the FMCC is asking of me now, and am I in compliance?
Sure, Mike. I think, and I echo those issues. I think in a lot of cases, what we tend to see is that most of the people that we're dealing with have multiple stakeholders who are asking them similar but slightly different questions from different points of view. I think one of the things where firms have an ability in this process to, I suppose, consolidate some of those things is by looking at how they're managing compliance, how they're managing risk, how they're managing their operations, and finding ways, I suppose, to put a framework together to manage all these things in one box and use a sort of a cohesive strategy to address those. And I found through, obviously, these kind of rules and requirements being in place in other jurisdictions that, rather than be managed by the request, there is ways in which you can manage the requests yourselves by making sure that you've processed a lot of these issues. And by the time the regulator comes in to look at what you're doing, you will already have put these things in place by operation of the way you do things. So I just thought I'd just highlight some of the questions. I think we had some questions come in. Really, there was a few questions on whether you need to have a custodian or not. And I think we just had a quick look at the Code of Conduct, and there isn't specific requirements to have a custodian. And obviously, this is interesting because it was something that came up in the context of AIFMD. Because in a lot of cases, essentially the assets are going to be held by your prime broker, or the money is going to be held in the bank accounts. I think, like at the time of AIFMD, the requirement was someone needed to be responsible for ensuring the assets were being custodied appropriately, and if those assets were being used for something other than obviously direct benefit for the investors, there needed to be an account to the investors as to what that was, and there needs to be clear understanding about who was taking the risk and who was getting the benefit of those assets. I think that question is going to come up for debate over the next couple of months. I mean, ultimately, I suppose in Europe, they took the decision to create this idea of depository light. And that became an industry in its own right. And actually, we spent a lot of time with trying to get to that solution with a lot of our clients and working with the prime brokers. But again, I'll leave that for another debate because it's such a big potential issue out there. Mike, you mentioned stress testing. I think we've got some questions on stress testing as well. I think some people have also said to me separately that you can do all sorts of stress testing, and actually during 2008 we were working on, well, 2007, 2008, we were doing risk assessment for firms, and we were highlighting things like business continuity and liquidity prior to the global financial crisis. But we would ask them, what are the stresses that you're looking at before it all happened? And then obviously the following year, basically, if the client was still operating, they had been through the stress test that was required, and essentially they felt they were able to weather the storm. But as you said, essentially the storms aren't always the same. The 2015 paper by the SFC is quite useful in looking at some of the storms. You've highlighted some of the processes that will be there. I think the IOSCO paper is going to be relevant. And I also think a lot of risk managers will have different views. I think, interestingly, from a market perspective, it's important to ensure that that people are using different scenarios, because if everyone uses the wrong scenarios, then potentially the whole market is in trouble.
No, I absolutely agree with you. I mean, risk management, a lot of people tend to think that it's all number crunching, but it is a bit of an art form as well. Particularly with regards to scenario and stress testing analysis. As I mentioned earlier in the webinar, it really comes down to the complexity of the strategy and what is most appropriate for you. Yeah, you're absolutely correct. If everybody's running the same stress test and scenario analysis, it kind of defeats the purpose. It doesn't seem like people are taking it seriously, and they're just kind of ticking in the box exercise. When I think the SFC is going to want to be like, okay, you're a long short equity fund, but why are you running something that's more related to fixed income products, or something like that? It has to be appropriate and pertinent to what your strategy is all about.
Yeah, no, absolutely. The other question was, when does this all need to be done? So from a timing perspective.
I think you said that in the beginning, did you not?
Yeah, well, I mean, it has a deadline of November 2018, but I suppose, technically we've seen that, a lot of the larger firms are already expected to have this in place. And, the audit teams will essentially have a screen for them to look at what firms are doing. Now, they may not be pushing for it until much later in 2019, but I think it will be an easy goal if they had a problem to go after these various issues. I mean, you have the defense that the guidance hasn't been implemented, but I think it's something that people need to be careful about. And I think also the risk assessment process, the review, how you're going to manage it, whether you're going to hire, whether you're going to have an external party, or whether you're going to get training internally, that's sort of decisions that you might need to answer on a much earlier basis so that you can prepare yourself for going through the processes at a later stage. Mike, there's something in the marketing documents as well that I think has been brought up. The private placement memorandum, the pitch book obviously has information in there, but I noticed there was something about also, it's not restricted to constitutional documentation. How does that work out in practice?
Right. I mean, now here, this is just my thoughts. I may be incorrect here, and I would highly encourage everybody to get legal advice. But what I think they're asking here is that, anything that you're putting in front of the investor, not just the PPM, but your pitch book, your AIME DDQ, it needs to be legit. It needs to be kosher. You cannot be falsely presenting something to them when you're marketing to them for them to invest into your fund.
Sure. No, sorry.
I don't know.
Mike,
I mean, is that your question? Sorry.
I might have misled you there. I was referring more to, if you refer to hard limits and soft limits, but potentially
right.
In the context of marketing your fund, it may not be
right.
in the PPM, might not be in the pitch book, but there might be something in your newsletter that you're talking about that you're trying to achieve. That could be a soft limit, and that could be something that you're judged against, because I think investors want to know.
Yeah, I mean, it's caveat emptor here. I mean, whatever you're putting out into the public, you better be very, very careful, because it's not only investors that will judge you. The regulators could glean that information as well and potentially hold it against you. With respect to the FMCC, the MIC, or some other sort of regulation or stipulation. Sure.
Okay, thanks, Mike. I mean, we did have a couple more questions. We'll go back to people individually. We will be making the webinar available, and we will be sending it around to everyone to be able to review at a later stage, just to answer that question that came through. I'm just going to go through a few of, I suppose, what I think is my conclusions on this sort of thing, and Mike can chime in as we go along. But essentially, the MIC has applied an additional responsibility on firms, increasing risk management's profile to match international standards. Reading it out, I suppose, but proportionality is available as long as risk management is effective or shown to be effective. And risk management is effective if the universe identified is identified and can demonstrably be effective in mitigating risk. So it's not just being able to have a process in place, but it's also demonstrating that it works, which is a difficult thing. The Fund Management Code of Conduct is for all managers, and it will require new skills for people in investment, operation, and compliance. You may need to hire in, you may be able to do without. It's more complicated than mere rule interpretation as risk evolves, so your process needs to be dynamic. The solution by design needs to be pragmatic, but it does not need to be difficult, nor does it need to be rocket science. And support is available. There is tremendous amount of learning and training out there. Anything to add, Mike?
No, I think that's a pretty good summary.
Okay. Good stuff. So just to take us through to the hour, I think one of the things that we were talking about is essentially providing, access to this sort of stuff. Most of our clients are already well up the curve on governance and operation, and have already looked at the risk management side of things. So, we're just interested in whether anyone has a particular interest in us putting on courses for risk management and risk assessment for hedge fund managers that might be appropriate for people who haven't been directly involved in that before, or even half-day sessions on investment risk. And that's something we're thinking of organizing. Please let us know if you're interested. On the implementation side, Cordium can help you put together your internal risk management policy and guide you through that process. If you have any questions on operational investment risk, please do contact either myself or Michael. Just to reiterate, you can log into and register on our Insights page. Obviously, do contact us in relation to training. And if you're looking for some governance, risk, and compliance support, please, look no further than ourselves. Thank you very, very much for attending this webinar today. I hope you found it interesting and informative. We will be sending the information out later. And I think from what we've been doing in terms of preparing this webinar, we've recognized that there's a lot more questions out there that people are interested in finding out about. So what we'll be likely to do is we'll be putting on further webinars of this type in the risk management, on the fund management code of conduct. And it's also likely that we will be publishing additional advices in regards to how this thing develops through to November 2018. So with that, I'd like to sign off by saying thank you very much to everyone who's attended this webinar. Mike, if you want to pass on.
Thank you, everybody.
That's great. Well, thank you very much, and everyone have a wonderful day.